Welcome back, everybody, for another deep dive. This time, we're going to the world of finance.
Exciting.
Yeah. Specifically, a trend that's less Wall Street flash and more like a silent seismic shift, the rise of passive investing.
Okay.
You might be thinking, isn't that a good thing? Low fees, less stress.
Yeah, it sounds pretty good on the surface.
Well, hold on to your hats because this deep dive is anchored in some research that suggests there's a lot more to this story than meets the eye.
A lot more intrigue than you might think at first glance.
Exactly.
Yeah.
So our deep dive today is anchored in a paper.
Yes.
It's called Hidden Power of the Big Three: Passive Index Funds, Reconcentration of Corporate Ownership, and New Financial Risk.
Quite a mouthful.
It is quite a mouthful,
Yeah.
but don't worry, we'll break it down.
Yeah, we'll make it make sense.
Exactly. So
Yeah.
this isn't just about numbers, it's about power dynamics, potential conflicts,
Ooh, juicy.
even whispers of stealth socialism.
Yeah, we always love those kinds of controversies.
Yeah. So, are these passive giants quietly reshaping the landscape of corporate America? And maybe even the economy as a whole?
That's a good question we're going to try to answer.
All right, so no more Gordon Gekko swaggering around. Instead, we've got...
Well, we still have some of those guys around.
Oh, they're still there.
They are, but this is a different breed.
Okay.
Yeah. This paper focuses on what it calls the Big Three:
Okay.
BlackRock, Vanguard, and State Street. Now, you've probably heard those names, but the sheer scale of their dominance is something else. They manage over 90% of all assets in passive equity funds. Think trillions with a T dollars.
Wow.
To put in perspective, they control more assets than the entire hedge fund industry.
That's pretty crazy.
Yeah, it's mind-boggling, right?
Yeah.
So it's not just that more people are choosing these index funds, it's that this huge chunk of the market is getting funneled through just three firms.
That's a good point.
Yeah.
So what does that actually mean, though? What does that actually mean?
Well, it means that these three firms are the largest shareholder in a staggering number of U.S. corporations.
Yeah.
A whopping 88% of S&P 500 firms. That's almost the entire index.
Yeah.
That level of concentrated ownership hasn't been seen since the days of the robber barons.
The robber barons.
You know, the J.P. Morgans and Rockefellers of the Gilded Age.
Oh, okay.
Yeah.
It's pretty amazing when you think about it. Yeah, but those guys, they flaunted their power, right? Yacht parties, buying up entire industries. These passive funds are supposed to be, well, passive. They just track the market, right?
Right.
So how do they actually wield this power if they're not actively calling the shots?
That's the real intrigue here.
Okay.
It's not so much about dictating terms. It's more like a subtle reshaping of the landscape.
I like that.
Yeah.
A subtle reshaping of the landscape.
Yeah. So one way is through their voting power.
Okay.
They hold such huge stakes that their votes carry enormous weight in shareholder meetings.
So even though they're passive, they still have a voice.
Oh, yeah, a very big voice.
Okay. But wouldn't you just expect them to side with company management? Why rock the boat if you're in it for the long haul?
Well, that's where it gets really interesting. The research found that they mostly do vote with management,
Okay.
except when it comes to board elections.
Oh, interesting.
That's where they've been flexing their muscles, potentially reshaping corporate leadership from the ground up.
Okay, so that's not passive.
Not completely.
That's not sitting back and collecting dividends.
It is, in a way,
Uh-huh.
but they're also being strategic.
Okay, so they're playing the long game.
Yeah, they're thinking about the future.
Okay, got it.
So, yeah,
Yeah.
it's definitely not just about sitting back and collecting dividends. They have other levers of power, too.
Oh, okay. Like what?
Well, the paper calls it hidden power.
Hidden power. That sounds ominous.
It is, a little bit. And it's a lot more subtle than you might think.
Yeah.
One tactic is what they call private engagements.
Private engagement.
Essentially closed-door meetings with company leaders. BlackRock alone had over 1,500 of these meetings in a single year.
Wow, that's a lot of meetings.
It's some serious access.
Yeah, that is some serious access.
Yeah.
So less greed is good and more diplomatic pressure. I mean, I'm picturing a very different scene than, the 80s movies.
Yeah, it's a different kind of power.
Exactly. But if it's all behind the scenes, how much influence can they really have?
Well, imagine you're a CEO and the largest shareholder in your company calls you up for a chat.
And that shareholder also happens to be the largest shareholder in a lot of your competitors.
Yeah, exactly. You were probably going to listen very carefully.
I'd be taking notes.
Yeah, it's a power dynamic unlike anything we've seen before.
And I'm guessing that's just the tip of the iceberg?
It is. There's also this idea of structural power. Because these firms own such massive, permanent stakes,
Okay.
Companies might start anticipating their wishes and aligning with their interests, even without any direct pressure.
It's like this unspoken understanding.
Right.
If you want to stay in our good graces, you better play by our rules.
Yeah, that's a good way to put it.
Okay, so we've got these passive giants wielding power in ways we're just starting to grasp. But is any of this bad? I mean, aren't lower fees and long-term thinking good things for the average investor?
Well, that's the million-dollar question, isn't it? And to answer it, we need to dig a little deeper into some of the potential consequences of this new financial order.
Okay, I'm ready to dive in.
Let's do it. Yeah, it really is a bit of a paradox, isn't it? Passive investing is often touted as a way to democratize finance,
Right.
but it could end up concentrating power in the hands of a few massive firms.
So lower fees for us, but maybe less competition in the market overall. How does that even work?
Well, the paper talks about this concept called horizontal shareholding. Essentially means that the big three often own significant stakes in companies that are direct competitors.
So they're invested in both Coke and Pepsi, for example.
Exactly.
Okay, but what's wrong with that? I mean, I get that it's weird.
Well, imagine you're the CEO of Coke,
Okay.
and you know that your largest shareholder is also the largest shareholder in Pepsi. Are you really going to go all out to crush your rival when it could potentially hurt the returns of your shared investors?
That's a good point. So it's like they're incentivized to just kind of play nice with each other.
Exactly.
More interesting.
And that lack of real competition could lead to higher prices for consumers and less incentive for companies to innovate.
Oh, I see. So why bother investing in R&D if you're not really worried about losing market share?
That's one of the arguments. Though it's worth noting that passive funds have also put pressure on active managers to lower their fees.
Okay. Yeah, that's true.
So there's a trade-off there.
It's like we're trading one form of market inefficiency for another.
It's a valid concern.
Okay, so we've got potential price hikes, maybe less innovation. Now, what about those systemic risks to the financial system that the paper talks about? That sounds scary.
Yeah, the concern there is something called investor herding.
Hmm.
Since passive funds all track the same indexes,
Right.
they tend to buy and sell the same stocks at the same time.
So if everyone's following the same strategy, doesn't that mean that everyone's gonna panic and sell at the same time too?
That's exactly it. That kind of synchronized selling can create sudden, dramatic drops in the market.
Flash crashes, right.
Exactly.
So basically, it's like a financial stampede.
Pretty much. It's a risk that regulators are watching very closely.
So is passive investing setting us up for another 2008-style meltdown? I mean, is that...
It's not inevitable, but it's a possibility that we have to consider.
Okay.
Yeah.
This also makes the whole stealth socialism debate you mentioned earlier even more interesting.
It does add another layer to the discussion.
So can you remind us what the concerns are there?
Sure. Critics of passive investing argue that it distorts market forces. They say that in a truly free market, capital is supposed to flow to the most promising businesses.
Yeah, driven by people making active decisions about where to put their money.
Right. But with passive investing, trillions of dollars are being allocated based purely on a company's size, not necessarily its performance or potential.
So it's like the invisible hand of the market is being replaced by like a giant robotic arm that's just shoving money around.
It's a provocative image.
Yeah.
And some argue that this shift could lead to less efficient allocation of capital and slower economic growth.
Okay, so we've covered a lot of ground here, and it's clear that the rise of passive investing has some very real downsides. But I have to ask, is there anything good about this trend?
Oh, there are definitely potential upsides as well.
Okay, good, because I was starting to get a little depressed.
I know it can sound pretty doom and gloom, but the paper does talk about patient capital as a potential benefit of passive investing.
Okay, what does that even mean? I've heard that term, but I'm not really sure I understand it.
Basically, because passive funds aren't constantly buying and selling, they tend to have a much longer-term outlook than, say, a hedge fund manager who's worried about quarterly returns.
So instead of just focusing on short-term profits, they can actually support companies that are making investments for the long haul.
Exactly. That long-term perspective could be a very good thing. It could encourage companies to focus on sustainable growth, invest in R&D, and even prioritize environmental and social responsibility.
So maybe there's a chance that these passive giants could actually push companies to be more responsible.
It's a possibility. And some argue that it's already happening.
Oh, wow. Okay.
There are examples of companies adopting more sustainable practices, partly in response to pressure from passive investors who are focused on long-term value creation.
Interesting. It's like aligning the interests of investors with the broader interests of society.
That's the hope, at least.
Okay, I'm starting to see the potential here, but this still feels like a pretty risky experiment, especially given the sheer scale of these passive giants.
There's no doubt about it. We're in uncharted territory. And the paper really challenges us to think critically about what kind of financial system we want and how we can ensure it serves the best interests of everyone, not just a select few.
That's a good point. Yeah, it's pretty mind-blowing to think that something as, seemingly mundane as index funds could have such a profound impact on the way companies are run. I mean, we're not talking about activist investors here. These are supposed to be passive investments.
Right, and that's what makes this whole line of research so thought-provoking. The paper goes as far as describing the big three as a kind of de facto governing board
Yeah.
for a huge portion of corporate America.
A shadow board pulling the strings behind the curtain. That sounds like a conspiracy thriller. But seriously, what are the implications of that for how companies are governed?
Well, traditionally, we think of a company's board of directors as being accountable to the shareholders. Right.
Right.
But if you have a handful of giant funds holding the majority of shares in most companies, that accountability starts to look very different.
Yeah, that's a really good point. It's almost like they're picking winners and losers without actually picking winners and losers.
Right.
And if these giant institutions are essentially making decisions that impact the lives of millions of people, shouldn't there be more transparency?
Absolutely. We need to understand how these firms are voting their shares, how they're engaging with companies behind closed doors, and what factors are driving their decision-making. I mean, what are their actual goals?
It seems like we need some new rules of the road for this brave new world of passive investing, maybe even a rethink of how corporate governance works in the 21st century.
Yeah, I think that conversation is just beginning.
Yeah.
And it's not just about regulations, it's also about awareness.
Yeah.
Investors need to understand the potential implications of passive investing, both the good and the bad.
So for our listeners who are maybe feeling a little overwhelmed by all of this, what's the key takeaway? What should they be thinking about as they navigate this new landscape?
I'd say the most important thing is to be informed.
Okay.
Understand the benefits of passive investing. Things like lower fees and long-term focus, right?
Yeah.
But also be aware of the risks we've been discussing. Do your own research. Don't just blindly follow the herd.
Yeah, don't just assume that everything's going to be fine just because everybody else is doing it.
Exactly. And remember that this is a really dynamic situation. The future of passive investing is still being written, and it's up to all of us to shape that future in a way that benefits everyone.
Well, on that note, I think we've given our listeners a lot to chew on today. It's clear that the rise of passive investing is a complex issue with some pretty far-reaching implications.
It's a fascinating case study in how financial innovation can have all these unintended consequences.
And it just highlights the importance of staying informed and engaged, even when it comes to what seem like really dry topics like index funds.
You never know where the next big disruption is going to come from.
Yeah, and I think that's a good place to wrap up this deep dive. Thank you to everyone for listening. We'll see you next time.